In recent videos, I've been emphasizing that investors are being presented with a unique opportunity to take advantage of the fact that financial markets are improperly discounting the risks of a all-out war between Israel and Iran. In this video, I'm going to explain why it is that historically speaking, markets have been inefficient in discounting major macro events. I'm going to briefly describe the history of some of these mispricings. I'm going to describe why that tends to occur. And then finally, I'm going to bring up this all together to analyze exactly how it is and why it is the market is improperly discounting the risk of a major war between Iran and Israel. The US market has a history of improperly discounting important macroeconomic risks. Let's go over a few of these most recent examples. One example was around 1999 and 2000. Almost every objective observer was able to see that valuations in the tech sector had reached bubble proportions. The stock market was pricing companies in a way that was completely irrational. And most objective observers were able to tell that this was eventually going to lead to a crash in the stock market. Many people started talking about the crash in early mid 1999, and yet the market continued to skyrocket upward during many months before the market finally did crash. The question is, why did it take so long for the market to react to these bubble conditions? Why did the market continue to go up, particularly in the tech sector, when it was clear that valuations had already reached irrational levels? A second example of where markets improperly discounted an important macro type of a risk occurred around 2007, 2008. By 2007, it was already very clear that the US housing market was collapsing and that the mortgage securities market was collapsing, and that both of these factors combined meant that the US financial sector was in serious trouble of major bankruptcies, insolvencies, and the entire US financial system was in serious jeopardy. This was something that was already evident by mid 2007. But the market continued to rise and went up to all-time highs and continued to rise all the way through to 2008. Why was this? Why did it occur that even though it was evident that the US economy was about to collapse because the financial system was about to collapse, why did the market ignore the clear evidence of this and continue to rise for several months? This is just another historical example of how this has occurred. Now, the most recent example of something like this was in the lead up to the COVID crisis. Those of you who know me know that about 2 months before the global economy crashed and markets crashed, I was warning about the high probability of a global pandemic developing that was going to cause a paralysis in the entire global economy and a crash of global financial markets. And yet the market essentially ignored this problem and continued to rise to all-time highs for 2 whole months, even when it was completely clear that several other countries had already shut down, the economies had already shut down, and that the pandemic was going to cause major damage to the global economy. These 3 relatively recent examples are examples of how markets inefficiently discount major macro risks. Now, the question is, why does this happen? Because most of us have been educated to think that financial markets efficiently discount risks. But we see with these 3 examples that they clearly don't. And so the question is why, and that's what we're going to address in this next part of the video. Now, to answer this question about why US financial markets don't properly discount major macro risks as they're developing, I'm going to first talk about this at a relatively high level of abstraction, And then I'm going to bring it down a couple of notches in terms of abstraction and talk about some of the specific reasons why historically this has occurred. And then I'm going to talk about some reasons that are much more contemporary, that are much more recent reasons why this is actually occurring in the market. So let's speak briefly at a high level of abstraction of what it would look like if the market was actually properly discounting risk. It would behave the way a rational individual would. A rational individual would make an expected return calculation where they would assess the probability of a certain event occurring, and then they would assess the downside that would result if that event occurred. So if you take the probability of the event occurring and multiply it by your estimated downside, the market should essentially adjust prices to account for this expected return. But what we've seen historically is that despite the fact that there's a high probability of a major decline in the market, right before the market actually declines, the market is actually right at all-time highs and trading at very high valuations. And so the first thing that we have to understand is that the market is not a rational individual. It's not a computer that's making a sort of expected return calculation. The stock market is a place where investors get together, and the market price simply reflects the opinions, the emotions, the feelings of a marginal buyer and a marginal seller. So in order to figure out what the price in the market is going to be in any specific point in time, we have to understand who that marginal buyer and who that marginal seller is. Now let's look historically at the behavior of the marginal buyer and seller right before a major market decline as a result of a major macro event. What has tended to occur historically is that major macro events have tended to occur late in the business cycle, and in particular late in a very big bull market cycle. And so there's some very particular patterns of behavior that occur late in a business cycle and late in a bull market cycle. Now, one of the things that we know occurs late in a bull market cycle is something that Nobel Prize winner Robert Shiller talked about, which is that late in a bull market cycle, investors tend to adopt very bullish or optimistic narratives about what is going to happen. And their interpretations of what is going to happen very much veer in an optimistic direction. So therefore, negative news or negative possibilities are sort of discounted and are assigned essentially a very low probability, whereas extremely optimistic scenarios are given a lot of credence and assigned a high probability. And so this is where irrational exuberance comes in late in a bull market cycle. So it's a major characteristic of marginal buyers and sellers late in the bull market cycle that they tend to look at the world with rose-tinted glasses, that there tends to be a lot of irrational exuberance in the way that people are interpreting different economic and financial narratives. Now, another thing that happens late in a bull market cycle is something that's called FOMO, fear of missing out. Because after a very long period of stocks rising, anybody that isn't fully invested in the market has been getting left behind. And as time goes by, these people get more and more frustrated. And eventually they sort of just give up and say, you know what, I'm going to buy at any price because the market just continues to rise. They have that fear of missing out. Everybody seems like they're having all this fun and everybody's making all this money and nobody wants to fall behind. So there's this general tendency on the part of the general investing public to have a fear of missing out when we're late in the bull market. It's very ironic because nobody's feeling like that when markets are actually down really low. That's when people should actually be feeling really anxious to actually buy stocks for fear of missing out on a really long bull market. But it's not until you're really late in a bull market cycle that people actually have this emotional need to jump in to stocks. But more importantly than what the average investor is feeling, what happens late in a bull market cycle is how the psychology of fund managers and institutional investors are what's occurring in their psychology. Because one of the things that we have to see is that for an institutional investor, a fund manager or hedge manager, underperforming the market in the context of a bull market can cost them their jobs. Nobody wants to lose their job. So even when a portfolio manager sees that stocks are expensive, that stocks are trading at irrationally exuberant prices, or there's a lot of risks, when they see the market rising, if they don't buy stocks at that time, they could actually get fired for underperformance, and they do get fired. And the most legendary example of this, I think, occurred around 2000 when Julian Robertson, who was a legendary hedge fund manager, literally had to close down his hedge fund because he had been shorting tech stocks that were clearly overvalued. But he started losing a lot of clients and losing a lot of money, and a lot of money started flowing in out of his fund, and he eventually just threw in the towel and shut down his fund literally just a few days right before the stock market crashed. This is the type of psychology that dominates late cycle psychology, what happens late in a bull market. There's just the fear of missing out that causes portfolio managers to have to be fully invested, even though they know they really shouldn't. Now, there's another factor that's at play here that also affects psychology late in a bull market cycle, which is what I would call the boy that cried wolf effect. Now, over a very long period of time during a bull market, there's going to be several instances in which various analysts were talking about various risks to the market, the possibilities of a recession, the possibilities of a market crash, certain types of risks that analysts think are going to cause the market to collapse. And the reality is that most of these things never actually materialize. And so after a while, investors just start to kind of tune out anybody who talks about risky things. And that's actually one of the things that, as an investor, it's so critical to understand the difference between market risks that could cause, let's say, a pullback in the market or maybe a market correction, and the type of risks that could actually cause a business cycle recession and a major bear market in stocks where you have a decline of 20% or more. The problem is that most investors don't know how to distinguish between these things. They think that when a guy is out there talking about things that could cause the market to go down and talking about a lot of risk, they equate that narrative with the type of narratives that actually could cause a major business cycle recession and could cause stocks to decline by 20% or more. And so when you get late in the business cycle, people are remembering all the times that people were talking about the possibilities of the market crashing and it didn't happen. So people just tend to discount that precisely late in the cycle. And when you combine this boy that cried wolf effect with the FOMO effect, it means that people are essentially going to ignore very important market risks for fear of missing out. Now, what I just described right now is the behavior of marginal buyers and sellers in the market historically. And these forces are still very much at play today. But I want to talk about now is about forces that are very particular to the point in time in history where we are right now. Because there's some very, very powerful forces right now that are causing the market to continue to rise despite the fact that it's evident that stocks are very expensive in light of major risks that exist in the market right now. And what are some of these very particular factors that are affecting the market today in contemporary times? Well, I have a whole video where I talk about why flash crashes develop. And I want you to go watch that video because I talk about this in great detail. So here I'm just going to summarize a couple of the main points. One of the biggest things that's happened in recent years is the rise of what I'd call value insensitive in trading and investing. Value insensitive traders, investors don't care at all actually about risk. And I'm going to explain why. There's two main classes of value insensitive investors. First of all, there's passive investors. Passive investors are people who, at the end of each month, take a portion of their paycheck and just plow it into an index fund. And also people that simply own index funds and don't sell it no matter what. For them, if there's a major risk of a war in the Middle East, they don't care. They tune all of that out. They have been trained by the financial industry and by the ideology that's been taught to them in the financial industry to buy and hold no matter what. So for them, it makes absolutely no difference if stocks are expensive. It makes absolutely no difference if there's a lot of risk in the market. They're just going to buy and they're just going to hold. And the number of investors today who are passive investors is actually greater than the number of active investors. So it's no wonder that markets today are actually more insensitive to risk as a result of the fact that there's so many risk-insensitive investors, value-insensitive investors. A second class of investors that might even be more important than this is algorithmic traders and various different types of program traders and technical traders that buy and sell automatically based on technical signals, particularly ones pertaining to momentum. These algorithms couldn't care less about whether there's a major war about to happen in the Middle East. That's not incorporated into the algorithm. These algorithms simply calculate generally indicators of momentum. And if the market is exhibiting positive momentum, then the algorithm triggers a buy signal. And when momentum slows, it triggers a sell signal. Fundamentals, value, whether stocks are expensive or not, generally don't enter into the buy and sell decisions of these algorithms. And certainly complex analysis of geopolitical factors, such as the possibility of the war in the Middle East and the possibility of an oil price shock, is something that doesn't factor into these algorithms at all. So what we end up having is a huge portion of daily trading in the market is dominated by traders that pay absolutely no attention to what's happening in the Middle East or what's happening at a macro level. And if you combine them with the other value-insensitive investors, the passive investors, what you end up seeing is that today in markets, an overwhelming portion of daily traded volume is dominated by value-insensitive investors that pay no attention to value and no attention to risk. And so therefore, it's no surprise that right now, when we are on the precipice of a potential war in the Middle East that could cause a major oil price shock and a major stock market decline, that markets aren't reflecting any of that risk at all, because the marginal buyer and seller in the market today is a risk-insensitive buyer and seller. It's a value-insensitive buyer and seller. And that's critical to understand. And that's a critical aspect of the inefficiency of the market, but this is providing us with an opportunity. Because if we're able to clearly identify a situation that is presenting risk in the market, and the market is not discounting it properly as a result of the fact that we have such a large percentage of traders and investors in the market that are value insensitive and risk insensitive, then that is providing us as active investors, and particularly as macro investors, with a major opportunity to outperform the market and make extraordinary returns. So let's talk briefly about the market opportunity that is being presented right now, precisely because markets are improperly discounting a major macro risk. What macro risk am I talking about? It's a risk that I've been discussing in a lot of my videos, and I really, really encourage you to look at my videos, particularly my videos pertaining to the oil shock in my playlist, so you can see my complete thesis about the risk of a major oil shock that could send oil prices above $200, even $300 per barrel, and what sort of effect that would have on the global economy and financial markets. But just briefly, there is a very, very high risk, more than 50% risk, that there's going to be an all-out war between Iran and Israel. In the event of an all-out war between Iran and Israel, global oil supplies are likely to be disrupted very significantly, particularly because it is likely that Iran is going to disrupt commercial traffic through the Strait of Hormuz, and Iran may also attack oil production and oil transport infrastructure in the Middle East in order to blackmail the global economy to try to get Israel and the United States to cease attacks on Iran, because Iran will be facing an almost certain military defeat if they get into an all-out war with Israel, not only because Israel is militarily superior, but because with the help of the United States, Israel is certainly militarily superior. So Iran, in a desperate ploy to salvage itself, and particularly to salvage the Islamic regime, will probably resort to this blackmail tactic of closing the Strait of Hormuz and perhaps attacking oil production and transport infrastructure in the Middle East. Now, I'm just going to go through some rough numbers here to kind of illustrate how you sort of identify what sort of an opportunity that we're dealing with. So, as most of you know, I believe that there's a significantly higher than even probability that there's going to be a major war between Israel and Iran, and that this is going to cause a major shock in oil prices. We'll just call it a 2 out of 3 chance, a probability of around 66.6%. And let's say that the estimated stock market decline in the sort of scenario I'm talking about would be roughly 50%. So if we have a 66.6% possibility of a decline in the stock market of about 50%, then the market should probably be off of its highs by at least 33, 34%. Now let's assume that you think that the probability is a lot more modest. Let's just say that you think that there's only a 1 in 3 chance, a 33% probability of a decline, let's say of 30% in the market. Well, in that case, the market should be off of its highs by probably at least 10%. Well, the market right now is actually at all-time highs, and not only that, it's at very close to all-time high PE ratio, which means that the equity risk premium is essentially near an all-time low. That's very, very interesting to think about, because right now we're actually in an environment that pretty clearly is probably presenting higher than average risk, and yet the equity risk premium that's being reflected in the PE ratios that stocks are trading at suggests that the implied equity risk premium that the market is trading at is near all-time lows. So this is how you can kind of in a very rough way, identify the major opportunity that's developing right now. And this is an opportunity that is kind of a two-way opportunity. On the one hand, there's a great opportunity to take advantage of the downside in the market and to take advantage of things that are going to actually perform well when the market is going down. But there's also a huge opportunity to generate massive positive returns simply by sidestepping the carnage, having a lot of cash in your portfolio so that you can buy stocks and buy funds when things are a lot cheaper after this sort of a crisis happens. And so this is a fairly rare type of an opportunity that happens once every 10 years or so, that investors are presented with an opportunity to take advantage of a macro mispricing. Now, just to talk very briefly about something that some of you may or may not be aware of, but there's been about 10 major oil price shocks in the history of the United States since 1945. 8 of those shocks were associated with business cycle recessions, where they either triggered or caused the recession, or at least were major contributors to the recession. And the other 2 oil price shocks contributed to major economic slowdowns that almost turned into recessions. Now, the median decline in the stock market that occurred in these 10 oil price shocks was a little over 20%. The mildest decline was roughly 15%. So if I'm right about a major oil price shock, we're going to be expecting, as in terms of a median result, a decline of probably at least 20%. But the thing is that I'm talking about a situation here that if the Strait of Hormuz is actually blocked by Iran, we're talking about a much, much bigger increase in oil prices, more similar to what happened in 1973 and 74 during the Arab oil embargo when oil prices quadrupled. And if we get a tripling or quadrupling of oil prices, I think that the decline that we're going to be seeing in the stock market is going to be closer to 40 or 50%, similar to what actually happened in 1973 and 1974. So major opportunity here right now. And I have two services that are really primed to take advantage of this situation. And I'd like you to just check them out if you're interested. The first is a product that I have on Seeking Alpha Marketplace. It's called Successful Portfolio Strategy. This is a pretty conservative service that only invests in ETFs and in stocks. And so it's primed to really take advantage of the situation, but in a relatively conservative fashion. I have another service that is much more aggressive that uses options. And my objective in that service is to really hit home runs, to really try to make extraordinary gains of hundreds of percent in the event that the scenario that I'm forecasting actually comes to pass. So depending on what sort of investor you are, you might be interested in checking it out. But regardless, what I want you to do is to subscribe to this channel so that you can continue to get my insights about what's going to be happening with this situation in the Middle East and how it might be impacting global financial markets and the global economy. I'm going to be talking about the subject very frequently and also talking about any sort of macro situation that could really be having an impact on markets. In fact, my next video is probably going to be on the US presidential election and what might happen in different scenarios depending on whether Trump or Kamala Harris wins. So thank you very much for joining me, and we'll see you next time.